importantly, what this cut on the stock today means for investors going ahead and how you should be viewing it, this stock. We have Mr. Kaustubh Pawaskar, the lead analyst at ICICI Direct, joining us. Kaustubh, hi, good afternoon. Thanks for your time. First of all, wishing you and your team a very happy new year. Let's understand a little bit more about the cut that we are seeing on Trent, Kaustubh. By now, every time in the recent past, Trent has come out with a disappointing update, the stock has seen a cut. One would imagine that by now the street would have penciled in that this is not a company that will now grow at that historical 40% levels. Why such a sharp cut then once again?
Yeah, hi. Good afternoon. Happy New Year to you and your team.
Thank you.
So basically, in quarter three, it was anticipation that there will be a better growth, uh, about 20%, largely driven by the festive, higher festive sales. I guess on your channel only I had earlier mentioned that we should expect a normalized growth of around 18 to 20% in trend from now, because now the base is normalizing for the company, and out of that, large part of the growth will be coming from the store addition what the company has been doing, and there will be low to mid single digit kind of a like for like growth. Q3, however, there was some anticipation that festive season followed by the GST rate cut, the benefit out of it would see in terms of better sales. Also, Trend has done a lot of rework on their portfolio at the store level. So there was a lot of optimism that in quarter three at least growth will be little better, and then there will be a normalized growth of around 18 to 20%. But the growth of 17% was below than what we and street were anticipating for the quarter.
Kaustubh, hi, this is Harsha. So you were penciling in 20% growth or higher than 20% growth for Q3?
So for Q3, we were anticipating around 22% growth.
Perfect. So that's a
Okay.
large miss
But
therefore,
but
Kaustubh. Sorry, please go
yeah,
ahead.
but on a normal quarter, we should expect growth somewhere around 18 to 20%, and that will be largely driven by store addition, while LFL like for like growth should be in low to mid single digit. Q3, largely because of the festive season, it was expected that there would be some push in sales, and on quarter basis the growth would be little better, but 17% growth was lower than what we and street were anticipating for the quarter.
They've gone wrong, Kaustubh.
Sorry?
Where do you think it's gone wrong for them? Because the miss is large, right? So I'm just trying to get a sense, your opinion on where is it that they've really gone wrong?
See, they have done change in their portfolio. That is for sure. If you go to the west side or studios, a lot of portfolio change has been done. But I guess even there is a lot of competition which is building up in this space, especially in the value fashion space. So I guess the consumers would also look for the new trials with new brands which are available in the market in the value fashion space. So competition is building up. The demand environment is yet to get that kind of push which is expected. I think these are a couple of factors along with the high base. If we look at the quarter three FY25, the growth was around 37%. So the base is normalizing, and we should expect 17% growth is better if we compare it to the 11 to 12% growth what the overall apparel market or retail market growth is for this quarter. So the growth, the base is normalizing for the company, and on a steady state, we should expect around 18 to 20% growth, unless there is something which is driving really well for trend in the quarters ahead. Maybe in terms of whatever a portfolio they are having at the store level, or whatever the churning which is happening in their portfolio in terms of new addition or fresh addition to their portfolio. If that is helping, we might see some improvement in the sales. But 18 to 20%, I think, is the normalized growth we should expect for trade in the quarters ahead.
And Kaustubh, taking a look at how you've rated the stock, you continue to maintain your buy rating, but in November last year, you trimmed the target price of the stock from 6,350 to 5,255. Are you seeing any further downgrades to your estimates after the kind of update that we've received?
See, it depends on how the margin picture would be definitely in Q3. So, but looking at the numbers, obviously there will be some downgrades. Also, if we look at the store addition number, for 9 months, it is around 90 stores what they are added, including the West Side and Zudio. So, traditionally we have seen Trent has been consistently adding around 200 stores per annum. Last year also in quarter 4, there was a exceptional addition in the Zudio's store. So if that might be the case, then we might see around 200 stores addition for FY26. Looking at the current store level or store addition level for this year, I think 200 would be a little difficult. I think they would be close to around 160 to 180 store addition for this particular year.
Okay, and Kaustubh,
So
let's
that
talk.
will again,
Yes, go ahead.
so that so that will again, have some impact, in terms of the revenue growth, what we are anticipating for the entire year.
Sure. Okay. And Kaustubh, let's talk about the valuation multiple at which Trent is trading right now. 90 times price to earnings. Yes, it has come down from its high, but so has the stock price. What is your take on where the valuation could settle, and what do you think a fair re-rating for the stock would be, given that the performance is lagging but it's still trading at 90 times?
So I think the stock has corrected by around 45% from its high. Then I think we should expect the time correction to happen, considering the performance, because I believe that it will take another 2 to 3 quarters for this base to normalize, and we should expect then the steady state kind of a growth. And I think that would be the point. One should look at what kind of earning growth CAGR the trend would see at a normalized basis, and that would give us some sense on what exactly the valuation the company would be comfortable. But I guess the stock has corrected from its high. I think the long-term growth prospect of the company is intact. The management has not changed their guidance, of 25% CAGR. So definitely, we must look from that perspective as well. What exactly the plans are would be from here, to improve that growth trajectory from the company's point of view. So the long-term growth prospects are intact. I think once the base is normalized in terms of the growth, I think we should look trend from the more steady state growth point of view.
Okay. Kaustubh, if one were to say that you revise your numbers, given the manner in which or the trajectory with which they are doing store openings, how much would that revision largely or approximately be? In what range? You're currently penciling in growth of 18 to 20%. In a good quarter, they're doing 17. Does it not concern you that this 18 to 20 may not be achievable? It could be base, it could be various reasons. But is there substantial downside risk to this story, is what I'm trying to understand from you.
So 17% growth, if you look into this quarter, so they have added 49 Zudio stores and I guess 17 West Side stores. So, the on that store addition level, they have done 17% growth along with, along with the growth in their existing stores. So I guess if we consider, similar kind of a run rate around 75 to 80 stores, I think 18 to 20% growth is quite possible. Okay, but if the store additions are higher or lower, then there might be some, uptick or downside in terms of the revenue growth trajectory. Also, how the demand environment is shaping up, how Trend is able to compete well with whatever the new brands which are coming up in the market. So all of these factors are important, in terms of the revenue trajectory going ahead.
Okay, and Kaustubh, you suggested that one of the crucial pieces is going to be margins. How do you expect the margin numbers to play out given the disappointment on the top line? Will that also have an impact on the margins in your opinion?
See, last two quarters, if or first half performance, if you analyze, I think Trent have done exceptionally well in terms of margin, despite the fact that there was a disappointment in terms of the growth. So I think from a margin point of view, they are managing it very well. I believe that margin should remain stable on YOY basis for the company. I think mix is very important in terms of analyzing the margin for the company going ahead. And the trend is an excellent has an excellent model, because I guess 95% of their revenues is coming from private label. So I think these are some of the factors which is make differentiating trends from the other companies, and that's why we maintain our stance that the long-term growth prospect of the company is intact. It is how the growth trajectory of the company from here, which we need which we have to look upon, and if it improves from the current level, I think these valuations will also improve.
And Kaustubh, lastly, just before we let you go, so do you believe this margin figure for quarter 3 could also be in the range of 17 to 17.5%, like it's been for the first half?
More or less, it should be in that range.
Okay, lovely chatting with you today, Kaustubh. Thank you so much for your time.
Thank you.
Thanks so much. Okay, viewers, on that note, time to slip into a very short break. Just glancing once again at what the market is doing right now. If there's been any recovery of any sorts on the index, well, not too much. Let's just pull up the Nifty and see what's happening. Further cut, in fact, 0.4% lower, and now around that 26,150 mark, slightly below that. On that note, time for a quick break. We'll be right back to talk more stocks on the other side.